Welcome to your market brief for Monday, November 18th from the NASDAQ market site. The Dow, NASDAQ, and S&P 500 set to open today's session in the green following another week of historic gains. I'll discuss what catalysts could keep driving U.S. markets higher with Yale professor Robert Shiller. Plus, Quadratic Capital CIO Nancy Davis is here with her view on rates and the Fed. Additionally, the strength of the real estate market will be in focus with building permits and housing starts, as well as existing home sales data from October being released. And earnings season also continues. The significant companies reporting quarterly results this week include Home Depot, Lowe's, and Target. Helping to spin the news forward is Mark Decambre, MarketWatch's markets editor. Hey there, Mark. Great to have you with us here.
Thanks for having me, Caroline.
All right, so we've heard from the majority of companies right now with Q3 earnings, but one group still left to report, retailers. In addition to Home Depot, Target, and Lowe's, we also have some mall chains. We have TJ Maxx. Is this still a survival of the fittest kind of environment? And if so, given how strong the consumer is, if those retailers aren't doing well now, can they survive?
Yeah, I think you're right. I think it's a big question about how strong the consumer is as well, because a lot of this economic boom that we've seen so far, or I should say stock market boom that we've seen, has been really based on the consumer. 70% of the GDP is based on the consumer. So retail sales need to be strong. We're headed toward a seasonal period in which we're going to see a good chunk of retail sales, and retailers, like you said, are going to report. We had good results from Walmart, and the hope is that we'll see some strong results from other retailers that come out. But it has been sort of a market sort of bifurcated, haves and have-nots, and those that have been have a great internet strategy, and we've seen that sort of play out. Walmart, Amazon, that's really been sort of the differentiating factor.
All right, this is a market, though, that seems very focused, tunnel vision on trade. Do the earnings, does the economic data even matter? What's going to propel stocks, the Dow past 28,000?
On to 30,000 perhaps? who knows? That's a big question, and I think we had some data recently from DataTrack today, DataTrack with Nick Colas and Jessica Rabe. They both talked about how we are actually having almost a throwaway quarter in a lot of ways, because 2019, like you said, we're still heading up higher, even though earnings have been poor. So the expectation is that markets seem to be discounting earnings. Third quarter, fourth quarter are expected to be poor, and they're almost making this bet that the trade war will somehow resolve itself and will head higher, but that's a big question for markets.
Lots of ifs in this market, so we have to leave it there. Mark, appreciate your insights. Thanks so much for joining us. All right, staying on the performance of U.S. stocks, I spoke with Nobel Prize winning economist Robert Shiller on Friday. He offered a unique perspective on the trade war. He believes, despite historic gains for markets, that many investors could still be keeping money on the sidelines. Watch this.
Uncertainty harms business. You end up saying, I'm going to go into a holding pattern for a while. Also, the trade narrative is particularly strong because it's associated with the Great Depression. The last big event has been called the Great Recession. We named it after the Great Depression. So we were reliving a bad experience in the past, and that one involved the trade war. So it looks like a scary scenario right now. If there's something that could calm us down so that we think that there isn't any more uncertainty on the front, it might help the economy a lot.
That was Robert Shiller, author of the new book, Narrative Economics, How Stories Go Viral and Drive Major Economic Events. You can watch the entire interview on Tuesday at Barron's.com and MarketWatch.com. All right, let's turn to bonds. Nancy Davis is Chief Investment Officer of Quadratic Capital. It's an investment management company where she established iVol. It's an ETF that enables investors to gain exposure to interest rate changes and fixed income volatility. She joins us now. Nancy, great to have you here.
Thanks for having me. Great to be here.
So let's start with this interest rate, volatility. How would you describe or assess the rates market that you've seen?
Well, I think in today's environment, there are not a lot of things that you can look at, not a lot of assets that you can say, oh, this is a value asset. But interest rate volatility, in my opinion, is a value play because it's been squashed from all of years and years and years of central bank money printing, and I think that's a little mispriced now, especially if you're considering less than a year ago, we had 3 hikes priced into the market. Here we are less than a year later, and we've actually had 3 actual cuts from the Fed. So it seems like a true value asset, in my opinion.
So value investing isn't dead. That's a kind of a question we've been hearing lately. But before we kind of get into positioning, what is the bond market telling you right now? Obviously, Fed policy and geopolitics have really kind of increased the focus on fixed income assets. But what is the bond market telling you now?
So the bond market is definitely saying there's going to be no inflation. The market is really priced for, no increase in inflation. And I think it's one of those times where you have to say, will the Fed actually be successful in normalizing inflation expectations? Or are we just going back into another cycle of rate cuts where the Fed is going to have to be cutting to maybe 0 and beyond? And it's really unclear.
So how would you advise investors to position themselves amidst this kind of uncertainty?
Yeah, I mean, that's one of the reasons we launched our fixed income ETF, IVOL. It's IVOL. The reason we did that was to give investors a way to access the interest rate markets. Most investors limit their exposure to just stocks and bonds, and the rates market is an institutional market for the most part, but by giving access to the OTC rates market as well as the government bond index, we thought it was a good opportunity for investors to be able to have a way of expressing whether there's a normalization of inflation expectations and the Fed is actually successful in achieving that mandate, or if we go back into potentially another recession and the Fed has to cut rates all the way back down again.
And you actually kind of have a bit of a warning for those passive investors who are just kind of sitting back and scooping up fixed income ETFs. What's that?
Yeah, so a lot of investors have something that looks like a 60-40 portfolio, and then on the fixed income side, a lot of investors are using some of the benchmark indices, like, for instance, the Barclays Ag Index. 26% of that index owns mortgages, and with a mortgage, the homeowner, you can prepay the loan at any point. So the owner of the mortgage is actually short volatility. And so I think it's one of those times where investors really have to step back and say, know what you own, so you're not implicitly short volatility in your portfolio. And so having things that are maybe outside of benchmark indices that are different and innovative can help diversify your portfolio.
What about in terms of emerging markets? What's interesting you?
I mean, definitely it's kind of the time for uncertainty is really high because you can see trade wars kind of being resolved or not being resolved. We are optimistic that things will be resolved, and you have to look globally. The US is very expensive, whereas the rest of the world is not as expensively priced. But equities right now are at all-time high valuations. So there is
So you're saying trade war, are you saying then opportunities in China?
Well, I actually personally think that China is kind of a sideshow, and I think we're going to have a trade war with Europe going into the U.S. election. That's contrarian. That's not a kind of an out there thought, but I feel like the trade war with China is what people are really focused on. But why not have a trade war with Germany?
Is that kind of how you're backing yourself up? Is that kind of your backup plan? If because if in terms of IVOL, what if the Fed keeps rates on hold?
Yeah, so with IVOL, most of the portfolio is long TIPS, which are U.S. government bonds. That's about 85% of the fund. And then we also have the option on the shape of the yield curve. So that does well in either environment if the Fed normalizes inflation, which could be a risk-on environment, or it could also be a trade war environment where we have higher prices but actually lower growth. So that would be stagflation. IVOL should do well from inflation in that example, but also if the Fed has to cut rates back down to 0, we're long government bonds, and we do well when the Fed cuts rates with yields in the front end. So it's not an explicit bet on interest rates, it's just on the move relatively between interest rates.
All right, we have to leave it there, but Nancy, thanks so much for joining us.
My
really
pleasure.
Appreciate it. Thanks so much for watching. Comment below and let us know what questions you'd like us to ask former CEO of Canopy Growth, Bruce Linton, next week on Market Brief. We'll be right here every Monday on the MarketWatch YouTube channel with everything you'll need to get the week started.